Hello, welcome to a new video. Ind AS 116 Sale and Leaseback Transactions. This is about accounting for sale and leaseback transactions at the measurement date when the transfer of the asset is a sale. Now, what is a sale and leaseback? A sale and leaseback is a financial transaction where an entity sells an asset and then immediately turns around and leases the asset back from the entity who purchased it. That means one entity is selling the asset to another entity and immediately leases that back from that entity. So there are two contracts. One is sale, another is leaseback. These two contracts are negotiated as a package with a particular commercial objective because they are typically interdependent. In fact, it's a combination of contracts because they are inseparable. Next, the seller becomes the lessee and buyer becomes the lessor. That means both the parties shall account for the transfer contract and the leaseback. Next, the seller continues to use the asset but no longer owns it. Before the leaseback, the seller was using the asset as an owner. Now it will use the asset, after the leaseback, as a lessee. Now, purpose. What is the purpose of sale and leaseback? A sale and leaseback is often used for the purpose of raising capital. One asset is sold, the seller gets money, capital is raised. Because you see, the sale of the asset brings in needed cash. The seller gets the needed cash with the help of which it can fulfill its commitments, obligations, or it can make new investments. Second thing is cost of using the asset is spread over multiple periods. Now the seller sold the asset, leased that back. That means he continues to make use of the asset. Now, when he uses that, it has a cost. How that cost is spread over? You see, cost of using the asset is spread over multiple periods by making the lease payments. So if I sum up, the seller gets money with the help of which he can make further investments, can fulfill the commitment, and the asset that he continues to use, the cost, it's spread over multiple periods because the seller makes lease payments to the buyer lessor. Now, sale and lease back. There are two parties, entity A and entity B. Entity A sells the asset to entity B. So entity A is the seller, entity B is the buyer as usual. Now entity B leases the asset to entity A. That means entity A sells the asset to entity B and immediately leases the assets back to it. So these two things happen at the same time. Sale of the asset and leasing back of the asset. So entity A is the seller lessee, entity B is the buyer lessor. That means for entity A, counterpart is entity B, who is the buyer as well as the lessor. And for entity B, counterparty is A, who is the seller and the lessee. Now, entity A being the lessee, it will prepare lessee accounting, right of use assets and lease liability to start with. And for entity B lessor, his accounting will depend on the accounting policy it follows. whether the lease is a finance lease or an operating lease. Perspective. Now we have to see what are the perspective. So we have to see first of all from the seller's perspective, then we will see from the buyer's perspective. The seller, the original owner sells an asset such as a building to a buyer, typically an investor. One entity is selling another entity one asset. So the buyer is the investor and seller is the investee. So seller, this generates cash for the seller, freeing up capital for other investments. What is freeing up capital? That means it can use that money that he gets. That means to available, make money available for further use. It sells the asset, gets the money, gets some capital, with the help of which it can fulfill its commitments, obligations, or can make other investments. From the buyer's point of view, the buyer acquires the asset and immediately leases it back to the original owner. That means buyer is the investor. He acquires the asset by paying money to the seller, but immediately leases it back to the original owner. That means, as I told you earlier, the original owner continues to make use of the asset as the lessee. Previously, he was using as an owner before the leaseback. After the leaseback, he is the lessee. Now, what is the return on investment for the buyer? The buyer receives a steady stream of rental income from the lease agreement. That means what? The lessee, the seller lessee has to pay a steady stream of lease rentals to the buyer lessor. So I repeat, buyer's perspective, asset bought, leased that back, paid money, he made an investment. How he gets return on investment? Because the seller lessee makes periodic lease payment, which is rent lease income for the buyer lessor. Measurement and recognition. You see, from the lessee's point of view, here it is called seller lessee. The initial journal entry is right of use asset, debit, and lease liability credit. So lease liability can well be measured, that is the present value of the future lease payments. We need to find out how do we measure the right of use asset? You see, the seller lessee shall measure the right of use asset from the leaseback at the proportion of the previous carrying amount of the asset that relates to the right of use retained by the seller lessee. That means the previous carrying amount of the asset having two parts. One part is proportion of the previous carrying amount of the asset that relates to the right of use retained by the seller. The other part is, that is, rights transferred to the buyer lessor. How do we measure the right of use asset? That is, it is the proportion of the previous carrying amount of the asset that relates to the right of use retained by the seller lessee. That means this becomes the basis for measurement of the right of use asset. Simple thing, if the thing is that this standard does not prescribe any method for determining the procedure. What we can do is that we find out what proportion of the fair value of the asset is the lease liability. Suppose lease liability is 80% of the fair value of the asset. That means right of use asset is 80% of the previous carrying amount of the asset. I repeat, we see what is the proportion of lease liability of the fair value of the asset. If the lease liability is 80% of the fair value of the asset, right of use retained is 80% of the previous carrying amount of the asset. Next, the seller lessee shall recognize only the amount of any gain or loss that relates to the rights transferred to the buyer seller. No profit and loss can be recognized from the proportion that is retained because one cannot make profit with oneself. So profit, gain or loss can be ascertained for the rights transferred to the buyer lessor. If 80% retained, 20% is transferred. That means what? Gain or loss on rights transferred is calculated just like gain or loss on disposal of a non-current asset. Now, this appropriately reflects the economics of the transaction. Scenario 1. You see, information given in regard to consideration of fair value of PP 11,250, carrying amount of PP is given 7,500, present value of lease payment 9,000, which is the lease liability. Now we need to calculate what is the right of use that is retained and what is the gain or loss on rights transferred. So what is the initial journal entry at the date of measurement? First is consideration, that is entity A, seller lessee, debit. He gets money from the buyer lessor. So cash, you see, debit. Now that asset is sold, so PP is de-recognized. You see, it is credit. PPE, you see, credit. Third is lease liability. One liability is created by entity A, seller lessee. How much? 9,000 rupees. Now we need to calculate what is the right of use asset retained. What is the percentage of PP? The PP is 7,500. It has two parts. One proportion is right of use asset retained. The remaining portion is rights transferred. So how do we calculate? We calculate what is the percentage of this liability of consideration of fair value. You see, this is 80%. Lease liability is 80% of consideration of fair value. That means ROU also will be 80% of the previous carrying amount of PP. You see, it is 6,000 rupees. How do you get? Simple thing. 80% of 7,500. So first we record cash debit, lease liability PP. These two we record. PP de-recognized, liability created 9,000. Liability, what percentage of cash? It is 80% of cash. That is the fair value of the PPE. Now, what is the right of use address? 80% of 7,500, 6,000. Now, balancing figure is the profit. That is gain on rights transferred. How do we get? We see the surplus 11,250 of receipts. One liabilities get 9,000 rupees. So surplus how much? This is 2250. And what is the proportion of the carrying of previous carrying out of the assets that is transferred? 7,500 minus 6,000. 7,500 total PPE, 6,000 retained, 1,500 transferred. Difference of these two is 750. That is profit and loss. That is gain on rights transferred. Now we go to the entity B. Entity B is the buyer lessor acquires one asset at fair value 11,250. So that becomes his opening carrying amount of PP and he paid cash of 11,250, that is credited. Now scenario 2, Consideration at fair value, same thing, 8,000. Carrying amount of PP 10,000. Present value of lease payment 6,000. That is the lease liability. So first we record cash that we have received, fair value of PPE. Second is we derecognize PPE 10,000 rupees. That is the previous carrying amount of PPE. That means before the lease back. Now present value of lease payment 6,000. That is the lease liability. So we need to work out what is the proportion of the carrying amount of PP, that is right of use assets retained. So first we calculate what is the percentage of lease liability of cash received. This is 75%. 75% of 8,000, that is the lease liability. So my right of use retained will also be 75% of 10,000 rupees. You see 7,500. This is 75% of 10,000. Balancing figure is the gain or loss on rights transferred. What is the balance? Balance, I repeat, loss on rights transferred. How do we check up this 500 rupees? First you see asset, carrying amount of the asset transferred, that is 2,500. And what is our gain? Our gain is 2,000 rupees. So loss is 500 rupees. So 500 is the loss on rights transferred. Entity B, the buyer lessor, same as previously. It gets asset 8,000 rupees. That is the initial carrying amount. The amount it pays for the consideration is paid 8,000 rupees, PP debit, and cash credit 8,000 rupees. Next, if the fair value of the consideration for the sale of asset does not equal the fair value of the asset, or if the lease payments are not at market rates, the entity shall measure the difference between the fair value of the consideration for the sale and fair value of the asset, and present value of the contractual payments for the lease and the present value of payments for the lease at market rates. I told you earlier that sale price and lease payments are typically interdependent because they happen at the same time, and for that they are negotiated as a package. They are inseparable. Sale at the same time, lease back, because both the parties having a particular commercial objective. Now, sale price of the asset, fair value of the consideration may be different. If the selling price of the asset is more than the fair value of the asset, it means what? Lease payments are likely to be higher than market rates. On the other hand, if the sale price is less than the fair value, lease rentals will be lower than market rates. So, fair value and market value, fair value of the consideration for the sale of asset may not be equal to fair value of the asset. So, the entity shall measure the difference between fair value of the consideration for the sale and fair value of the asset, and present value of the contractual payments for the lease and present value of the payments for the sale at market rates. Now, selling price more than fair value, it is lease rentals will be higher. Selling price less than fair value, for example, lease rentals will be lower. Now, how do we treat this? Consideration above market terms, that means financing provided. Consideration below market terms, that is prepayment of lease payments. So if the consideration more It is, if it is about market terms, it is financing provided. That means what? For the seller lessee, it is financial liability because the buyer lessor providing funds, and for the buyer lessor it will be financial asset. Other side of the picture below market terms, that means lease payments prepaid. So for the seller lessee, it will be prepaid lease liability because it is accepting less amount of money. And for the buyer lessor, it will be prepaid lease receivable. We just take examples. Scenario 3. Consideration paid 16,500, you see. Carrying amount of PP 10,000. Fair value of PP is 15,000. Present value of this payment 13,500. First you see consideration paid 16,500. Fair value of PP is 15,000 rupees. That means 1,500 is paid more by the buyer to the seller. 1,000 what? That is funds provided above fair value of PP. So it is a financial liability for seller lessee because he has accepted more money. He should have received the fair value of 15,000, but he has received 16,500. It's a financial liability for him, and for the buyer lessor it is financial asset. Total lease liability is 13,500. That is for both financial liability and liability, I mean the lease liability. So if financial liability is 1,500, lease liability for the lease, I mean, it will be 12,000 rupees, 13,500 minus 1,500. Now I show you in detail. First, we record consideration 16,500 cash received. Okay. Next one is what? We de-recognize carrying amount of PP. One part is retained, another part is rights transferred. Third is financial liability. I told you earlier how to get financial liability. 16,500 total payment made above fair value of PP. That means 1,500 funds provided by the buyer to the seller. So what is my lease liability? 13,500 the total lease liability. Out of that 1,500 is financial liability. Balance is lease liability. 13,500 minus 1,500. Now we need to work out what is the right of use asset retained. That means we have to find out what is the percentage of lease liability of the fair value of PP. How much? This is 80%. Fair value PP 15,000 rupees, lease liability 12,000. So lease liability is 80% of fair value of PP. That means right to be retained will be 80% of PPE. You see 8,000 rupees. How do we get 80% of 10,000? Now the balancing figure is the gain on rights transfer. That is 1,000 rupees. How do we get? Our surplus is 15,000 rupees, fair value of the PPE, lease liability get 12, 3,000 rupees surplus, and cost of the asset, I mean the proportion of the carrying amount of the asset, that is 2,000. 10,000 minus 8,000. 10,000 total PPE, previous carrying amount of the asset, 8,000 right of use retained, and 2,000 is rights transferred. Difference is 1,000 rupees, both sides tally. Entity B, buyer lessor, it gets an asset, fair value is 15,000 rupees, he pays cash 16,500. So difference of these two what? He is providing finance to the seller lessee, entity B providing finance to entity A, that is 1,500. So what is financial liability for entity A? Financial asset for entity B. Okay. Next. Scenario 4. Consideration 12,000 rupees. Fair value of PP is 15,000. Carrying amount of PP is 10,000. Present value of this payment 10,500. That is the, as you know well, that is the lease liability. Here you see consideration 12,000 rupees, but the buyer said should have paid how much? 15,000 rupees fair value. He is paying 3,000 rupees less. This 3,000 is what? Check up. First, we record 12,000 rupees amount that has been received. We have received 3,000 rupees less. We derecognize previous carrying amount of PP 10,000. Now, what is the lease liability given? Present value of lease payment 10,500. That is 70% of 15,000. 15,000 is the fair value of PP. So prepaid lease liability is how much? 3,000. That is 15,000 minus 12,000. Now, what is right of use asset retained? That is 7,000. You see, 70% of previous carrying amount of the PP, 70% of 10,000. Balance is profit and loss. Gain on right transferred 1,500. You see, 15,000 is the fair value, 10,500 lease liability. So gain is 4,500 and cost of asset, I mean proportion of the previous carrying amount transferred is 3,000 rupees. 10,000 minus 7,000. So profit is 1,500. For entity B, PP is 15,000. Initial carrying amount is the fair value. He pays cash how much? 12,000. Balance 3,000 is prepaid lease receivable. So you see, what is prepaid liability for entity A? It is prepaid lease receivable for entity B. Thank you.